Hey guys, my name is Max. I appreciate y'all for being here, man. It is all out war between Defiance and Yield Max and Jay and Roundhill and the whole bunch of them. We're going to look at the new funds that are coming out from Defiance. Now, it went around Twitter yesterday. It says right here, Defiance NASDAQ 100 Lightning Spread Income ETF. Effective date April 30th. So these are around the bend, but and we're going to talk about what they're doing, and it's real exciting stuff. But it was misreported yesterday that these were going to pay daily, and that is not true. I have tried to confirm that it's not true, and to the extent I'm able to, yes, it doesn't. It's not going to happen. In fact, they haven't announced if they're going to pay weekly or monthly yet. They haven't even announced it. But daily is probably unrealistic to hope for. All right, so what I want to do today is look at the prospectus, and we'll look at option strat and see what this strategy really does. And then we're going to backtest it. We'll see how it would have done. We'll compare it to the other Defiance strategies and see how it does. Anyway, I appreciate y'all for being here. All right, so let's go to option strat. The heart of the strategy is something called a bull put spread. And the whole time they did the Defiance triple QI, I always told Jay, why don't they just sell a put spread? When you sell a put spread, you don't have unlimited loss on the downside. And I know the reason they didn't, because it's not yield max. You wouldn't be able to yield max. It would be, kind of a middle or mids or whatever. It'd be not much yield. So that's why they didn't start with it. But now they have all those types of funds out. Now they're doing the more creative strategies. And this is the kind of stuff I would have done from the get-go. So it's great to see they're finally coming around. This is a great trade by itself. What the trade by itself is you usually you buy a slightly in the money put, or I'm sorry, you sell a slightly in the money put, like a 60 delta. And that's basically the same put that Defiance sells every morning. They sell the 60 delta. The triple QI sells the 60 delta. So you sell that, but then to protect it, you buy a lower delta. Like in this case, I'm going to say they're probably doing 60-30 or 60-40, but they do some kind of structure like that. And they do that every day. See, that brings in a credit, $946. And, that's about 33% a day. Just if they do, it depends on where they put the strike. So, this trade has a 49% chance of profit. What they do that no one's ever done before, well, first of all, there's no funds that just sell a put spread. I wish there was. I thought the original Defiance fund should have done this, or something like this. But not only that, now they're doing this, but they're combining it with a long stock position. Now, the SPX, you can't buy stock in the SPX. You can buy stock in the SPY and sell options against it. In this case, they're going to use other options. They're using a three-legged spread. I love me a three-legged spread. So they're going to buy a call, and that call that they buy is going to be deep in the money and go out in time. So let me just put it in here really quick. A lot of people maybe call these stock substitutes, or, you're synthetically trying to recreate the stock with this deep in the money. We'll go out like 3 months to May, and then we'll see see that delta, there's an 81. That means this option gets 81% of the upside. That's not really probably enough. Let's go down here to the 5,600 strike. It gets 88% of the upside. Let's try the 5,500 strike. It mathematically should get 89.9. We're going to round up and call that 90. That's what they call the lightning spread. It kind of has a lightning effect. What this does is it makes you double long between the two strikes. So, and that's on a daily basis. This other thing, you keep this option and hold, but you keep selling these options for that $900 income daily. But what it does to your results is, and you can see where the line's steeper in the middle. The line is steeper. The profit loss line is steeper between 6,100 and 6,125. That's because you're double long there. You're long through the deep in the money call option, and you're long through the bullish put spread. All right, because you're selling puts, which is bullish. All right, so that's kind of the nuts and bolts of it. Let's go here and see what they say. I don't want to bore you guys. There'll be other people that will read all this to you. Fund's primary objective is daily income. Secondary objective is capital appreciation. They keep referring to daily income, but they don't mean paying daily income. They mean earning daily income and paying it regularly. Hope, but they don't. I think I wasn't the only one. I thought it was possibly going to pay daily too, but I wasn't the only one that's confused. A bunch of people on Twitter think the same thing. Okay, so it says the lightning spread. I've already told you this: buying a long dated deep in the money call option and writing put spreads, 0 DTEs. I told you all the good stuff. I told you that we were double long between the two strikes when you do this strategy. They describe it in a little different way. They say, suppose the fund holds a deep in the money call option and sells a put spread with the strike 2% apart. Okay. If the index declines by 3% in a single day, if a person does a strategy, the market's down 3%, you're going to be down 5%. What they're saying is you're also exposed to the risk of the width of the put spread. I was just describing it as being double long between those 2 points, but you know, between the two strikes of the put spread, you have extra exposure. So you would lose 3% from the market dropping 3%, but then you would lose 2% from the sold put spread. Now, they don't tell you the good things that can happen, but there's good things that happen when it goes the other way. But that is something you have to know. That is the risk in the trade. That's how the trade gets beat. Okay, so you know, the fund will seek to provide daily income in the form of cash distributions. There is really nothing else in here that I found, and this is so preliminary. They might change this and everything. They don't even have an expense ratio on this or a ticker or lots of stuff. Anyway, okay. So who cares, you know, how fancy the strategy is? Tress had a really fancy strategy that I was in love with the strategy, but it was, you know, Tress had issues and not that many people bought it and they had to close Tress. Is this going to be like Tress? You know, because this is kind of a more exotic strategy that's kind of harder to wrap your brain around. But I don't think so, and I'm going to show you why. So anytime any of these ETFs come out, the first thing I do is I get in Tasty Trade. And you can recreate what I just showed you an option strat in Tasty Trade, and then you can go back in different periods over history and look how that would have performed. One of the first things I always do whenever I'm looking at any strategy that Jay puts out there or that I'm thinking of or anyone's, or I hear of a new ETF, I put it in option strat and I run it through 2022 or I put it in Tasty Trade. Tasty Trade has you can select different periods of history. So watch this, inflation-induced bear market. So this goes from January 3rd, 2022 to October 1st. Okay, now these are the strikes I just described to you and stuff. I won't bore you with it, but let's see what happens here. Okay, now look at this. The white line is the market. The market went from S&P went from 4,800 to 3,600, right? I mean, you guys remember that drop. It's about a 25% drop, right? I remember it. It was nasty, and it was a slow grind down. It didn't just happen and bounce straight back. All right, well, look at this freaking strategy, guys. The strategy made money. If you would have just buy and held the market, you were down 27,000. This strategy, this three-legged beast of a trade, would have made money, would have made 20% during that time frame. To the extent that we can trust the back tester. But that's impressive. So here's what I did to check it. I went and I opened a duplicate tab. And in this tab, I have just sell 160 delta put. This is what triple QI does now, or in this case, SDTE does now. Just sell one of these every day. Okay, so we'll run it through the same thing. We'll run it through 2022 and see how it would have done. Okay, well, the red line is us, and it was doing well for a while, actually. But then by the end of the year, it lost money. Now, here's the thing about selling options. It lost less than just buying and holding the stock because you're getting premium in. It lost about 10 or 20% less than buying and holding the stock, but it still lost money for the year. So that's how, so we would expect in a 2022 pullback for SDTE to be down, but not as much as the market as far as total return goes, but probably be down 70, 80% as much as the market. And that's kind of what this test would indicate. But the new strategy would actually be up. Now, so is this just an anomaly, or, is this just one thing? So let's test it through some different time periods. Let's test it through 2020. Let's test it through we'll also test it the last time Trump was in office, the trade war roller coaster, and see how it does in there. What do you bet Jay designed this to do well during the Trump administration? I know he did. Okay, so we'll look at the pandemic panic sell-off, and no strategy did really good. I don't expect the strategy to have done well during that. I just want to see what, how it did. Okay, well, buy and hold during the pandemic sell-off. So that's from Feb 3rd, 2020 to April 30th. Okay, so it's February, March, and April. Pretty rough time. Vicious bounce down and then just a vicious bounce back. Well, buy and hold would have been down 14,000. The strategy's only down half of buy and hold. That's pretty impressive. That's pretty impressive. So now let's test Defiance's, the SDTE strategy during COVID. And, and of course the bounce back is going to kill it because it's totally capped on the upside, but pandemic panic sell-off. So Feb, March, and April, we'll see how SDTE would have done. And SDTE, that's, people don't realize how good SDTE is. In this case, SDTE outperformed the new strategy. That's impressive. That's impressive. And I guess I can't explain why that happened, because they're selling, even though they're selling puts and they're totally capped, as vol gets tracked, they're able to sell the put far enough out of the money because it's the 60 delta put they're selling. But as vol gets tracked, that's 2 and 3% out of the money. So they're able to capitalize on those bounce backs. But they were definitely down. I mean, buy and hold, they were, buy and hold was down 33%. But like I always tell you, they were down less than buy and hold. They were down 17%. The funds are a lot safer than people realize. But yes, when the market's down 5% in a day, these funds will be down, 4.5%, and that's scary. But anyway, all right. So during COVID, we're going to have to give SDTE in the old style the win. This one still did well, though. This one did very well all right, so let's go back. Let's test it for the tiebreaker. We're going to test it, both strategies, through the trade war roller coaster of 2018, last time Trump was in office. Trade war roller coaster. So Jan 18 to the end of 2019, two-year time frame. So this is the three-legged, lightning strategy, the newfangled lightning strategy. Let's see how it does. All righty. Well, buy and hold would have made about $10,000. The lightning strategy would have made $42,000. Okay, so we have a strategy that would have been positive during 2022 in the back test. Would have been negative during 2020, but less so than the market. Okay, but during 2018, 2019 would have made 4x. Are you serious? Are you serious? Now, granted, the strategy, look here, buy and hold is only down 20%. The strategy was down 47 at one point. Strategy is more volatile than buy and hold, but it's, it's twice as volatile, but it's 4 times as profitable. So this has better risk-adjusted reward. Buy and hold was up 20%. The lightning strategy was up 86. That's why he's doing this strategy. He's doing this strategy to beat a Trump administration, or to try to profit off the crazy volatility. Let's see how the old-fashioned just selling a put spread, just selling a naked put SDTE strategy, the current strategy, would have done during the trade war roller coaster. All right, so okay, the current strategy would have done all right during that time frame, would have done better than the market. Market was up 20%. Current strategy was up 24%. Look at these details. The only reason we do any of these strategies, but in this case, we're just going to show it. Look at this average premium. This strategy brings in a daily average premium of $1,300. That's per contract. And it holds on to about almost 10% of that. You know, that's not bad. It holds on to $100 of that on average every day. So the current strategy is not bad. What people don't like about the current strategy is these huge losses. Look at some of these huge losses. Look at well, I mean, you could see some of these losses are gigantic. The end of October of 2018 was nasty. I mean, in these, you know, some of these losses were just gigantic. And even though you had some nice wins on the other side, they weren't near as big. And, you know, that's the reason why people don't like the current group of funds. I guess I should have done this. I could have put SDTE up there, and so it has the same symbol that we're looking at the back test. Okay. Now let's look at, there's no doubt during 2018 it was better. So let's see how in an all-out face-ripping bull market, which one does better. Let's talk about the bounce back after the pandemic sell-off, the post-pandemic surge. This is, you know, May 2020 to December 2021. Let's see just an all-out face-ripping rally, which strategy does better, selling the naked put or selling the put spreads with the call option. Okay, that's a pretty good looking test right there. Holy cow. Are you serious? Are you freaking serious? Okay, buy and hold is 67%. This is triple buy and hold. The max drawdown is you know, 50% more, 60% more, but you know, triples buy and hold. I mean, that's really impressive. Okay. So now we're going to go back and see how just selling the naked put spread would have done. This is the SDT, the current strategy for SDTE. So we're going to say it's post-pandemic surge. Okay. All right. Well, I'm going to declare the new strategy the winner. But I mean, let's talk about this. So the new strategy on the post-pandemic surge would have tripled just buy and hold, according to the backtester. The old strategy, just selling the naked put, would have done really well too. You'd have brought in some income, but you actually underperformed buy and hold. And that's typical. We see that. That's what we'd expect. Most of these covered call funds, especially the ones that are fully capped, and I know this is a naked put. It's the same thing as a covered call for mathematically anyway, kind of. So, you know, the fully capped ones generally over a long enough period of time underperform. So let's let this be, so we expect that. Let's let this be the final tie break. Let's test both strategies over the past 3 years, because that includes 2022, which is bad, but it also includes 2023, 2024. So we'll let that be the final tiebreaker. So first we're going to punch in past 3 years. And this is the three-legged beast, the lightning spread. Now remember, we tested just 2022 separately, and this thing was positive. So we know that it's going to be positive during 2022. And then what, we don't know how it's going to test the rest of the way, but that's impressive just in itself. I'll probably get this the day it comes out. And I'm probably going to drop, I don't know. I have to figure out something, but the current ones are great too because we'll talk about it. Okay. But so this is over the past 3 years. Now it goes flat here at the end because we're using a 90-day option. So it can't backtest within 90 days, but anyway, it'll still close enough to be able to tell. So that's, we're going to now run the regular way for the past 3 years, just selling the naked put. And then we're going to compare them. Then I'm going to let you go and get on with your Saturday. I know you guys got better things to do than look at these back tests. I stayed up late working on this. I was going to do the video last night. I couldn't believe how well this strategy tested out. Okay. So here we have, we'll do it this way. We'll start with the current strategy. The current strategy for the past 3 years would have done great. It would have made 50,000. Buy and hold would have made 60. But what I always say is the reason you do this, it's in the details. It's this average premium. You're making $2,500 a day per contract. With this, you're grossing $2,500 per day per contract with this current strategy. Now you're only netting $85 per day, but that's another story. But that's another story. You have about twice as many wins as you have losses with the current strategy. Unfortunately, that's the problem with this strategy, is these large losers. Your largest loss in this case is about triple your largest win, but you have twice as many wins as you have losses. Okay, so now we'll look at the new strategy. So the new strategy right now, just looking at the graph, the orange line is the profit, is the equity curve. So look at this. When the market is down in 2022, your equity hits a high. That's the good news. Now, the bad news is with this strategy is that's the last high you see for about 2 years. It's not all good. But then when this strategy, then in about 2 years, when this strategy kicks back in, it kicks in. This strategy is introducing some different dynamics. The put spread, in addition to the stock replication, this is introducing a whole new set of dynamics to it. But it's allowing you to profit from volatility going crazy. Sometimes volatility's up and the market's down, and that happened in 2022. And in that case, this fund will do all right. Okay. Sometimes volatility's up and the market's up, and that will happen that happened during this time frame. That happened in 2023 and 2024. Volatility was jacked, and it's been happening lately also. Volatility up, price up. Well, the fund can also profit in that case, and that's what's been happening lately. Some cases, you have the case that price is up and volatility's down. That happened in early 2023. Price was creeping up, but volatility was down. The fund was not able to profit to the degree they were in earlier, in 2022 or later. So this it introduces a third dimension to it. But for diversification and stuff, I mean, look how well it did. Look how well it's been doing recently. But I mean, here's the trade-off. We went from August 2022 all the way to Feb 2024 without making a new high in the fund, in the strategy, while the index during the same time frame, the index went from 4,200 to 4,800. A lot of people would have dumped the fund when it started doing this, would have thought it's the worst fund ever, would have probably dumped it right down here at the low. But anyway, that's just the way it works out. But at least we know that going in. So obviously this isn't for all your money. None of these are, but this might be a good diversifier. This might be a good diversifier. I just think that's impressive. And I just want to show this back test one other time. I can't get over how impressive this is. The inflation-induced bear market, 10 months of 2022. We went under the 200-day moving average, and we're in an all-out bear market. And this strategy is unbelievable that it could have made money during that time frame. Unbelievable. All right, guys. Well, I appreciate y'all for being here. I just wanted to do a quick video and let y'all know what kind of to expect. I read the prospectus, and it's pretty much bare bones. We'll be getting more information. Jay Pestruccelli is going to be on my channel on Tuesday at 5 o'clock, I think, 4 or 5, something like that. And I'm going to probably live stream it. So if you want to watch during the live stream, he'll take questions from the audience. I appreciate you guys for being there, but we're going to be talking about put spreads a bunch, I am sure. All right, guys. Well, I really appreciate y'all for being here, and have a wonderful Saturday.